Yesterday, folks, I did it. I purchased another $10,000 worth of the S&P 500 Index VOO, and it's starting to rally a little bit today. But nonetheless, as I mentioned, I'm going to be more aggressive as the market downturns. And we can see from the last month high, the S&P is down about 6.6%. I am a little fearful, however, that we're going to see the S&P bottom out at around $300 to $320 per share on the VOO position, but we'll have to pan that out and see. Like I said, I'm not trying to time the bottoms. I'm just going to aggressively buy the downturns, and I do have more money set aside to purchase a little bit more into the end of the year if we continue to see downturns here. But I added this to my corporate account where it was worth about 27,000. Now that I've added another 10,000 US, that brings it up to 36,000. I now have about 135,000 CAD invested into VOO, just over 100,000 US. But what I want to do today is break down the components of these ETFs to see how they're performing, because yesterday I did consolidate and completely sell one of my ETFs in favor of another one that I'm going to be revealing in this video. If that's a conversation you think you'd appreciate, hit that like button. But first and foremost, the components of the S&P 500 VOO have been changing pretty dramatically this year, because we can see the top 5 holdings consist now of Apple, Microsoft, Amazon, Google, and Berkshire Hathaway. It wasn't much more than a month ago that Tesla was in that top 5 position, and it wasn't much more than I think 5 or 6 months ago that Facebook was up here as well. But we can see, because of the automatic market cap weighting, the way this system works, this passive system of weighting stocks by market cap, you know, it's just kind of crazy to see that Tesla's starting to bottom out. We'll see if it remains on the S&P top 10, you know, the way it's been selling off. But let's look at the performance of the top 5 here real quick, because Apple year to date is down 25%, Microsoft is down 26%, Amazon down a whopping 49%, Google's down 38%, and Berkshire Hathaway, the only green in the top 5, up 2.8%. But with all those other holdings, it's still pretty incredible to see that on that year-to-date basis that the S&P is only down 19%, when those top-weighted movers are down much, much more than that. But it comes back to that poised question of which one do you buy? Because the problem is you don't know what are going to be the best or the worst performers. And as I made that decision in the first quarter of this year to go into the indexes, to let this market volatility, this recessionary period, sort out the best and the worst stocks, it's better to have that broader exposure than that knit exposure and end up picking a stock like I did, like Algonquin Power or Facebook or even Tesla at this point, that could really devastate your portfolio by upwards of, you know, 50 to even 80% to the downside. And speaking of that, let's talk about the better performing stocks. I did sell my VYM ETF. Now, I kind of divvied this up between 2 different ETFs, with VYM and SCHD as my US dividend focused ETFs. However, I kind of was thinking about it over the weekend, and I was really looking into these 2 different ETFs, and I said, look, if I had $1 million, I could only put it into 3 different ETFs. What would they be? And SCHD actually came up for me well above VYM, just because of the historical performance. Even the dividend growth rate over VYM is substantially higher on SCHD, and it gives you a bit of a different exposure rating, whereas VYM gives you a lot of the similar stocks that are held in the S&P 500, which is just focused on those large cap dividends, whereas SCHD is more focused on the Dow Jones 100 dividend stocks. So it gives me better diversity, a much, well, not much, but a little bit higher of a dividend yield. And I ended up just consolidating all of my VYM into SCHD. So now I think I have about a 70 to 80,000 CAD dollar valued position in SCHD, which makes up about 20% of my portfolio. But taking a look at those top 10 holdings here, guys, the top 5 we'll try and analyze: Broadcom, Pfizer, Lockheed Martin, Merck & Company, PepsiCo. We got Verizon moving up the list, Coca-Cola's in here, Home Depot, Cisco, and then there's IBM down toward the bottom. This list has actually changed quite a little bit over the last few months as well. Lockheed wasn't this high up, Pfizer wasn't this high up, but once upon a time Merck was the top company in here. It's fun to analyze them to see how they've been shifting through this volatile market. But let's just take a look, because the performance of this ETF has been absolutely marvelous. I should show you by the year-to-date basis, it's only down 7.55%. You tap on the 3.3% yield, and you're definitely outperforming the S&P 500. But take a look at Broadcom, the top current positions, down about 15% year-to-date. Pfizer, guys, down 8%, not doing too bad. Very good performance out of Pfizer, these healthcare companies. Lockheed Martin, the defense company, you know, this rockets, dealing with the geopolitical events. No surprise that this kind of defensive plays up 38%. Merck & Company, other healthcare guys, up 44% year to date. Pepsi's up 6%. You really start seeing the broad diversity of owning more than just the S&P 500 to stabilize your portfolio and still yield great long-term results. I mean, look at the 5-year performance on SCHD is up 46%, and VOO over the last 5 years, guys, is actually underperforming that, which is kind of staggering to say. So it's kind of good to get that broader based exposure to different indices just outside of the S&P 500. But again, it kind of just complements a lot of the same stocks because most of them do sit in that 500 list. So putting that aside, let's talk about VDY till I motherfucking die, my favorite Canadian dividend ETF, my only real exposure to the Canadian market, and I'll probably just consistently continue to buy into this as I have over $140,000 now in this ETF. I bought like another $5,000 worth, and I am sidelining some cash to top up my TFSA, where some of that will be going into SCHD, VOO, and along with this ETF here. Year to date is outperforming the S&P 500, only down 6.11%, but on the 5-year doesn't even come close to the trailing performance of SCHD or VOO. And on the long term, guys, again, we're not talking about the most stellar performance, but what we are talking about is a monthly paying dividend ETF that has a yield of over 4%, which again, SCHD is only around 3.3%, and the S&P is like 1.5%. So this one, if you scaled it over a 10-year period with that 4% yield, guys, non-reinvested, not talking about the dividend increases, you're talking about an extra 40% return here on the 67%. So you are getting a doubling of your income or doubling of your investment every 10 years, which is my bare minimum for any investment I'm making. If the stock didn't double over the greatest bull market in human history, then it's not a stock that I really want to own. So this one definitely made the list. And just taking a look at the individual components here, we're talking about really concentrated ETF, however, because unlike those other two, we can see Royal Bank makes up 14% of the exposure. We have TD in here and Bridge Bank of Montreal. You kind of get the idea that the Canadian markets are largely financially exposed. Our biggest companies, literally the 3 largest companies in Canada, are Royal Bank, TD, and Enbridge. So it's nice to see they're mostly the upper weighted of this ETF. And they're also super high, super stable dividend paying stocks, which is awesome. But we got Bank of Montreal, Canadian Natural Resources, Bank of Nova Scotia, Suncor, TC Energy, BCE. So the reason we can see this has been doing so well is kind of the energy exposure, which has balanced out some of the downturns we've seen in these bank stocks. But nonetheless, Royal Bank exceptionally doing well this year. I mean, it's only down 5.68% with a starting yield of over 4% on a 5-year basis, doing very fabulously. These are very stabilized companies, so it's nice to see that these are the top weighting of the ETF, with TD doing very well this year, again, only down 11% with a 4.3% starting dividend right now. And Bridge here, guys, actually flat for the year, doing very, very well. Again, we're not talking about crazy explosive growth incomparable to the other ETFs, but it does complement my portfolio very well and offers that monthly income that I so desperately want. But let's take a look at BMO real quick, down about 12% on the year. Starting yield is 4.6%. And then, of course, Canadian Natural Resources, which has just been absolutely crushing it, up 36% year to date. So it's very fun to take a broad view of all these different ETFs, see how they are actually performing through these volatile recessionary periods. And you start really realizing very quickly why having a single idea of just, I only need to own the S&P 500 isn't always the best idea. I know a lot of people want that global exposure, and you can buy things like VT, a lot of you continue to ask me about. But again, I like focusing on my Canadian stocks, my US stocks, and again, knowing that you get global exposure through those without having to directly buy, say, European stocks, though there's some good ones out there like Hershey's I really like, British American Tobacco, another really good dividend payer. But you can also get into some of the Chinese stocks if you're kind of risk adverse to that with BABA, JD.com. A lot of value investors are into those things. But honestly, I just like having my core exposure to these stable markets that I understand very well. But I'll pass the question off to you. I'd love to know what you guys think about this. I will be doing a full portfolio overview very soon, so consider subscribing for that because I've been doing a lot of shuffling around into the end of this year.